Boa tarde a todos, obrigado por estarem aqui, é um prazer receber todo mundo aqui. Bom, como vocês sabem, estou aqui, a gente vai receber hoje o Mauboussin. Michael, ele é o Head of Consilient Research da equipe Counterpart Global, do Morgan Stanley. É uma equipe que faz gestão de 75 bilhões de dólares em renda variável apenas. O Michael, ele começou sua carreira no Credit Suisse, passou pelo Blue Mountain e depois pela Legg Mason. Além disso, também o Michael é professor adjunto de finanças da Columbia Business School há 30 anos e ele é também presidente do Instituto de Conselhos de Curadores de Santa Fé. Michael também é formado por assuntos governamentais da Universidade de Georgetown. Okay? Além disso, o Michael também é autor e coautor de 4 livros, dentre eles Quais, A Equação do Sucesso e o More Than You Know, que é o livro mais famoso dele, já foi traduzido para 8 idiomas e foi eleito pela Business Week em 2006 como o melhor livro de negócios do ano. Então, nosso encontro será uma moderação com Q&A, feito por mim e pela Juliana. Eu e a Juliana trabalhamos na equipe de seleção de fundos internacionais aqui da Bradesco Asset. A gente vai passar um recado também, porque além das perguntas que nós teremos aqui, teremos os convidados e também por celular, não é, Ju?
Isso, se vocês quiserem mandar alguma pergunta, o pessoal que está aqui ao vivo está vendo o celular aqui, mas a gente mandou no Teams também o número de celular, vocês podem mandar as perguntas para a gente em português ou em inglês, e a gente recebe aqui e vai fazer as perguntas ao final para o Michael. Então, podemos começar.
So, Michael, thank you for being here with us. I'll let you introduce yourself if you want to say something.
Well, first of all, thank you all very much for your time. It's wonderful to be with you. I really look forward to the conversation. I appreciate all of your hospitality. The one thing maybe I'll mention, I don't know if you, I don't know, my Portuguese is not very good. I don't know if anybody knows what Consilient Research means.
That was supposed
Oh,
to
that's
be
your question. Okay, that's
that
a
was supposed
question.
to
You
be
answered that.
the first question.
Okay, so let's just say, I'm going to say I'm thrilled to be here. I'm really looking forward to the conversation. Yeah, we can bring out some fun stuff as we talk about it. So let's chat.
Okay, thank you. So we're pretty much familiar with Counterpoint Global Research approach to investing and selection. We'd like to know, first and foremost, why the name of Consilient Research and what is your role and how do you permeate the process of the analysis at all into the company?
Thank you very much. Well, let me start first with Consilient and where the word Consilient came from. And I could trace back the story to this to a baseball game in 1996 in Baltimore, Maryland. And I was sitting with Bill Miller, and I had a beer in this hand, and I had a hot dog in this hand. And Bill turned to me and said, you know, you should really get involved in the Santa Fe Institute, which I'd never heard of. By the way, some of you have been maybe gone to see Oppenheimer, the new movie about the atomic bomb and Robert Oppenheimer. That, of course, much of that took place in Los Alamos, New Mexico. Santa Fe is obviously very close to that, and the proximity is not a mistake. It's actually many of the original Los Alamos people came and were involved in the Santa Fe Institute. And the Santa Fe Institute's all about, the founders felt that academia had become very siloed and that there was too much discipline, too much focus on disciplines and not across disciplines. So they founded this institute to say, we're going to look at very hard problems, unified by complex systems. And we're going to go across academic boundaries. So it doesn't matter what discipline you're from if you can contribute to the problem. So I went there and it was great. And I was very intoxicated intellectually by much of what was going on there. And that led me to, I was reading a lot in evolution and biology and so forth. And it led me to a book called Consilience by E.O. Wilson. E.O. Wilson died recently, but he was a very famous biologist. Most renowned for his work on ants. So if you like ants and ant colonies, and they're very cool, by the way, E.O. Wilson is your guy. And he wrote this book called Consilience. It's a word I had never heard of. It was a word that was coined in the 1800s, and it means essentially the unification of knowledge. The argument that Wilson made, which obviously resonates a lot with SFI, but really my own way of thinking about things, was that science has made extraordinary strides over the last 400 years through reductionism by breaking things down into their components. But there's a limit to what we can understand through reductionism, and that's especially as relevant to complex systems. And so for us to move forward, we needed this idea of unification of knowledge, consilience, bringing ideas from different disciplines to bear on what we're doing. To tie this a little bit back more to the investment community, I would say the person who's been the greatest advocate for this set of ideas is Charlie Munger, Warren Buffett's partner at Berkshire Hathaway. and what he would call the mental models approach, right? Robert Hagstrom wrote a great book called Lattice Work about this idea of mental models. I think that very much consistent with that. So I was very inspired by this. So I'm like, I'm going to start a series. You mentioned more than you know. I'm going to start a series called the Consilient Observer. And the idea is I'm going to look at topics around investing, but try to bring this perspective of science or psychology to see if there's something insightful that we can add to that. So More Than You Know is basically the greatest hits of the Consilient Observer. So I'm talking to Dennis Lynch about joining the Counterpoint Global team, and we're trying to think about what would be a fun title for this team and so forth. So Dennis was like, let's call it Consilient Research. I was like, yeah, that's cool. And I said, the 5 minutes of every meeting we're going to have for the rest of my life are going to be explaining what Consilient Research means. So here's another example of that. But it's a really cool concept. It's obviously very unique. And I'm a very, very big believer in this. I think that as an investor, we're obviously in the game of learning and updating our views and so forth. But I do think there's enormous value in learning big ideas from different disciplines and trying to apply those. And that means reading widely, a lot of, having friends in different walks of life, making sure they're part of your life, understand what's going on with all that. So I just think that's a very valuable, first of all, it's intellectually fun, but it's very valuable. And the way I finish with this thought, that the way I like to think about this, and this is, I think, going back to Munger, is that when we face problems in the world, we want to have a very rich toolbox so that we have the right tool to solve the problem that's in front of us. And I think of this mental models, this Consilient way of thinking as a way to build a very full and useful toolbox. The challenge is sometimes you read about something, you're learning about something, and it'll be a tool, and you'll put it into your toolbox, but it won't be useful. But you don't really know when it's going to come in handy, right? So this is just building up these tools, I think, over time I think it's intellectually fun. It's not everybody's cup of tea, but it's intellectually fun, and I think it just makes you a better thinker.
That's great. Some of us have heard about the mental models, but just a few walk the talk. And you guys you are one of those rare men that walk the talk towards mental models. That's great.
Try to, yeah.
And reading some of your books and some of your papers and researches that you publish, it's very obvious. And obviously, with everything you mentioned now about Consilient Research, you obviously have a very curious and unsettling mindset. How did you start your intellectually curious mindset around research and investments, and especially valuation?
Yeah, it's a good question. By the way, I spent most of my youth obsessed by sports. And,
which sports?
Sports. Oh,
sports?
Which ones? Yeah, which ones?
Ones?
Well, in high school, I played soccer. And
like most of
like everybody
the crowd
here,
here.
you can all relate to. Yes, exactly. And I also played ice hockey, and I played lacrosse, a sport lacrosse. It's probably not big in Brazil, but some of you know about lacrosse. It's a very cool sport, by the way. And my love of those sports were the opposite of my skill in those sports. So my favorite was hockey, my second favorite was soccer, and my third favorite was lacrosse as a player. And I was best at lacrosse, second best at soccer, and third best at hockey. So I ended up playing lacrosse in college, and so I was very interested in all that stuff. So I didn't spend a lot of my youth reading. And interestingly, I think people are surprised to hear this. I grew up in a family household with no books. My parents were very bright. They didn't go to college, but they were very bright, and they're very focused on education, but they were not modeling by reading lots of stuff. So I was possessed by this other thing, and then I went to college, and I was a kind of an okay student, not a great student, but I went to college, and I found, interestingly, I think many of you, I'm sure you've all had the same experiences. You take courses that you never expected to be very interesting to you, and so you start to see there are little sparks of things that are interesting out there. But to answer your question more directly, because I can really pinpoint this. So I went to Wall Street in the mid-1980s. I was in a training program, but it's important to underscore that in university I studied government, liberal arts, did not study business, did not study finance at all. So when I got to Wall Street, now, fortunately, the training program had classroom work that was remedial for me, so I could learn, come back up to speed. But I found myself completely confused by what everybody was talking about. And so I remember one day at a research meeting, the utilities analyst talking about the utility stocks trading at 17 times PE, but growing very slowly. And then the tobacco analyst talking about the stocks trading at 12 times earnings and they're growing really fast. And I said, I don't know much about multiples, but this makes no sense to me whatsoever. Like, why would the slow growing thing get a high multiple and the high growing thing get a low multiple? So it didn't make any sense. So I was very fortunate for a series of reasons that one of the colleagues in my training program gave me a copy of Al Rappaport's book, Creating Shareholder Value. And that was a lightning bolt that struck me. And there were three messages from that book that remained at the core of everything I do. One is it's not about accounting numbers, it's about cash flow. By the way, Rappaport was a professor of accounting, but emphasized cash flows. And I really very much think that's an important lesson that we come back to over and over. Second is that strategy work and valuation work have to go together. I teach at Columbia Business School. You go to Columbia Business School, you'll learn about strategy. So you'll learn about 5 forces and value chains and disruptive innovation and game theory and all that cool stuff. And then you'll walk down the hall and then you learn finance, discounted cash flow and CAPM and Black-Scholes and all that good stuff. But if you're an investor, you need both of those things simultaneously, not one or the other, right? So to value a business intelligently, you need to understand strategy, and strategy has to create value. And then the third thing, which ended up being the point of our collaboration, was he wrote a chapter called Stock Market Signals for Managers. And the argument was stock prices reflect a set of expectations for future financial performance. Now, his target was executives, but clearly relevant for all of us as investors as well. So that was the opposite side of the same coin. So I immediately sort of embraced the Rappaport mindset. And when you say what fired me up about valuation, that was it. And so I became a junior analyst and then a senior analyst using this Rappaport methodology. I, by the way, first met him in May of 1991. It was like the thrill of my life. And then we ended up collaborating on expectations investing. So that the first version came out in 2001, and then the recent version came out in 2021. Rappaport is now 91 years old. He lives in San Diego, California. I saw him just in June. He's awesome. His mind has never been better. Amazing. I exchange emails with him. He's like a second father to me. He's extraordinary. So it's super cool. The other thing I'll just mention to you, I don't know if this is good news or bad news, but expectations investing, we just got the email yesterday, will be translated into Portuguese for the Brazilian market. And that should be coming to a bookstore near you in 2024. So the reason I say I don't know if it's good news or bad news is because you may prefer to read these books in English versus Portuguese, but I don't know how good the translation is going to be. But anyway, that's it. And so that got the whole thing going on valuation. I would just say that's how I got so excited about it for many years. And that's, by the way, how I transitioned to being a strategist, because for years I was an analyst, and they would come in and they say, oh yeah, tell us about your stock recommendations, but we don't really care that much about that. Tell us about how you value businesses. So I sort of migrated to be the valuation guy versus just an analyst.
Thank you. And our teams here, we have people from the investments teams from all over our bank, which is a pretty sizable bank, catering lots of different clientele. Can you just tell us what are some of the biggest mistakes that investors make when they're doing their decision-making process?
Yeah, I mean, I think that the couple that come to mind are the two big ones I would say are overconfidence and confirmation bias, right? So let's start with confirmation bias. To be a good investor, I mean, we'll use some fancy language here, but to be a good investor, the key is to have a view of the world that you are willing and able to update appropriately as new information comes in. And the fancy way to say that is to be a Bayesian, to use Bayesian analysis, right? So you have a prior, new information comes in, and that information changes your prior in the proper direction, in the proper magnitude. Very easy to say, extremely difficult to do. And so confirmation bias is this bias that prevents us from updating our views in an appropriate fashion. So to me, that's a really big one. And then overconfidence, the main way that tends to manifest is that we think we understand the future better than we do. So specifically, if I ask you for a set of scenarios that might unfold for a particular company or an industry or what have you, it is extremely common for people to get ranges of outcomes, optimistic or pessimistic, that are vastly too narrow, and they underestimate the range of things that can possibly happen. So a lot of the tools that we try to help people with in decision-making are tools specifically to make sure people are thinking about distributions that are sufficiently rich, and that through their decision-making process and documentation, that they're allowing themselves or compelling themselves to update their forecasts intelligently and consistently. Now, this is one where your colleagues can help you, because if you've written down, here's what I believe, here's what I think is going to happen, and that doesn't happen, we call it a signpost. It's an opportunity for you to slow down and say, okay, how do I change how I think about this particular situation? So it's an excellent question. I think there were other things. I mean, we talk a lot about in our own firm. I mean, Dennis is one of Dennis Lynch's favorite ones. He just thinks other one that he would put in this is classification, is that people classify things in certain mental buckets that may or may not represent the underlying entity. And that taxonomy or that classification in and of itself blinds people to opportunity or risk.
Great. So you've been teaching at Columbia for 30 years now. You also teach a course, very famous course, Security Analysis, that was once taught by Benjamin Graham, who was Warren Buffett's main inspiration. So this is the question that we're looking for the most. Since you started, the world has changed a lot over the past 30 years. So we'd like to know, what are the key lessons that a student learned with you in this course? And what's the evolution that you've been observing over the past 3 decades?
It's a fabulous question. Yeah. And by the way, it's interesting. There's also a nice little thread here that the student who took my class, who's probably become the most famous, is Todd Combs, who now works with Warren Buffett. So for me, and Todd has come in as a guest a couple times. I got to interview him for the Graham and Dodd breakfast last fall, which is a real thrill. And he, as a student, kept in touch with me. So, when he got the job, I was able to send him a congratulatory email and so forth. But it's pretty cool to be able to say to the students that in this seat, sat a guy who ended up working for Warren Buffett, right? So we have this beautiful tradition, as you pointed out, starts in 1927 with Ben Graham, and now we're coming up on a century of this, which is really cool. I break my course into 4 different parts, and when I talk about each of the parts, maybe we could talk about what's new or what's been introduced. And they're actually, one of the sections is all brand new. The first part is about thinking about markets. And I think the argument I would make is, if you're an active manager and you're picking stocks or bonds, you are engaging in a bold activity, because you are saying to the world, I think I know something that the person who's selling it to me doesn't know. And oh, by the way, it might even broaden that to say that the market doesn't know. That is an audacious proposition, right? So how do you justify that? And the answer is, you have to think systematically about the sources of inefficiencies. By the way, a good friend of mine who ran Ziff Brothers Investments for many years, a guy named Ian McKinnon, he's actually going to be at the Columbia Investment Conference this February of 2024. He calls these POSIs, which stands for Pocket of Structural Inefficiency. What are the POSIs? And he says, we want to have lots of POSIs. So we tend to categorize those, and I'll just say that I've talked about this for a long time, but we are more rigorous about it, is behavioral inefficiencies. So this is a behavioral finance type of issues, and this is the wonderful question about, second is analytical. So we all have the same information, but some of us analyze better than others. The third would be informational. Obviously, you don't want to do anything illegal, but can you cobble together a mosaic that allows you to see world in the ways that others can't? And the final one is technical, which is, are people selling or buying for reasons that are non-fundamental? My colleague Joel Greenblatt wrote a very famous book, You Can Be a Stock Market Genius. One of the big stars of that book is spinoffs. And spinoffs are a good example of people just blow them out because they don't care about them. how that component of the course has changed a great deal over the last 3 decades is introduction of the markets, thinking about markets as complex systems. So here you can see the direct stamp from my experience at Santa Fe, which I had not heard of when I started, to now where this becomes sort of the key way of thinking about markets. And by the way, if you go back, I mean, Warren Buffett has said something that I always thought was interesting. He said, there are only 3 chapters you need to read in investing that will give you the foundation that you need. That's quite an audacious statement. And he said, you can do this in an afternoon. The first is chapter 8 from Intelligent Investor by Ben Graham. And that's on the metaphor of Mr. Market. I want to come back to that in a second. Second is chapter 20 from Intelligent Investor, which is about the margin of safety. And the third is chapter 12 from Keynes, called The State of Long-Term Expectations. He said, if you read these 3 chapters and you understand them, you're good to go. Okay, going back to Mr. Market was a metaphor that, Graham talked about, but I don't think he wrote about it, and then Buffett popularized. The idea that this market is sort of almost has a personality and is sometimes overly excited and overly depressed. And your job is to take advantage of Mr. Market when he's you sell when he's too optimistic and buy when he's too pessimistic. So I gave a talk and I wrote this up, but it was called specifically Animating Mr. Market. And the argument I made is that you can use the tools to understand and describe complex systems and map them almost perfectly as a way to understand the wisdom of crowds and the madness of crowds. So I think there's a very intimate link. So that's number 1 is markets. Number 2 is on valuation. And if I had to say there's one component of the course that's been most consistent, it's that the value of financial assets, the present value of future cash flows. And I suspect if we came back here 100 years from now, we'd hopefully have the same conversation. I don't think that should change. What has changed a great deal in the valuation work is the work on intangibles. And maybe we can talk about that separately in a few moments. But the nature of investment has changed. And as a consequence, tracking investment and return on investment, how we measure return on investment, has also required to evolve. And that's the stuff I think has been very different. And that's, by the way, a lot of that stuff is actually the last 3 years, 4 or 5 years that we've been doing that. Competitive strategy analysis is the third building block. What is a good business? How do we think about that? I can just point to one thing that's absolutely brand new, which is the work by Clay Christensen on disruptive innovation. The Innovator's Dilemma came out in 1997. That was a few years after the course started. And folding that in has been very important. So the competitive strategy, a lot of it, I've learned a ton. We actually have introduced a lot of stuff on what's called the value stick. So it's a value creation framework. We can maybe talk about that, like how to think about willingness to pay versus price and those kinds of things. And then we've also put in a lot about incentives of organizations. It's interesting that an economist will typically assume that companies seek to maximize value, which most of them probably should be doing, but you recognize quite quickly that sometimes they're family-held businesses, sometimes they're businesses owned by private equity firms, sometimes they're private companies that are not family-held, sometimes they're public companies. So they all might have different time horizons, different objectives, different goals, and those may have interesting implications about how they compete with one another. Then the fourth and final building block, which is new since the course started, is on decision-making. So this is precisely to say, if you're in this room, I'm sure that you know about the heuristics and biases literature, you know about prospect theory, you know about these core ideas. All that is fine, but the challenge is not to know about the ideas. The challenge is to build into your process tools and techniques to manage or mitigate them, right? So it's not enough to know about overconfidence or not enough to know about confirmation bias. It's important to know, what do I do about that so that I, in my process, am checking for it consistently. So the course, in many ways, the core is the same. It's cash flows and value. By the way, I'll just mention as a side note that this week, I'm part of this thing called the Hauerbrunn Center for Graham and Dodd Investing. Every year, the Hauerbrunn Center sponsors 40 students at Columbia Business School. They apply for it and are accepted to be in the value investing program. So this is sort of the elite force of our investing community. And this week, today is the last day of it, is our block week. So these students come in and they get intensive, it's like military training, right? And the guy that runs that program is Tano Santos. Tano is the one that teaches. He runs the Hauerbrunn Center and he teaches this block week. I wanted to hang out with Tano and the students this year. So this year I went Monday and Tuesday, I actually went to block week and listened to talk about all the stuff on valuation. And, it's very encouraging. Tano goes out of his way to call it modern value investing. And just, again, knowing the core principles that Graham laid out for us, how powerful those ideas are, but how we can introduce modern concepts to make them more workable, relevant, and applicable in our jobs today.
Great. So allow me to add a second thought to that question. You said that intangibles has evolved a lot over the past years, specifically to your course. So is this the key that make you sleep well, buying companies with a 50, 60, 70 times earnings?
You're joking about that. Yeah, exactly. By the way, a third of all companies in the United States lose money. It's interesting. I mean, a third of all listed companies lose money, so it's not an unusual effect. Yeah, the basic set though is as follows, and I'm going to give numbers for the United States, but these are numbers that are, the basic story or pattern is true around the world. In the late 1970s, tangible investment was double that of intangible investment. Okay, so when I say tangible, think physical assets, machines, factories, inventory, all that kind of good stuff. Intangible, by definition, non-physical. So think software code or training or brand building or all that kind of stuff. So 2-to-1 ratio in 1970s. Since then, that ratio is not quite flipped, but today the ratio is something like 1.5 times intangible to tangible. So in my career, roughly speaking, I've seen this flip, right? So that's really interesting. Now, going back to core principles, what is an investment? An investment is an outlay today in return, or the hopes of the returns of cash flows in the future that more than justify what you pay today. And it doesn't matter if you're buying a machine or acquiring a customer or buying an ad on Meta to get someone to buy your good or service. And so the key is to understand that investments are investments. And by the way, the first report we wrote about this, we called it One Job. And the point was, the one job of an investor is to figure out the magnitude and return on investment. And I'm here to tell you, if you understand the magnitude of return on investment, like everything else is easy, because all the numbers fall out of that quite directly. But the devil's in the details here, right? So what are these intangible investments? How do I identify them? And how do we deal with them? So the key here is to understand that in the selling general administrative lines, SG&A of companies, in there are going to be maintenance spending numbers to sustain the business, and then they're going to be discretionary intangible investments. So underscore that, discretionary. These are money you're choosing to spend to grow the business, right? So how do we identify those? And by the way, there are a number of different techniques that have been laid out for this. Chuck Holton at University of Maryland had an early paper from, I think, 2006, where he did this for Microsoft. The most famous framework is called Peters and Taylor, two authors, where they talk about 100% of R&D being intangible investment and 30% of non-R&D SG&A. So a lot of quants use Peters and Taylor, but I'll just give you guys a tip. There's a brand new paper that was just accepted at Management Science, which is a leading journal that you can find now on SSRN, Social Science Research Network. Came out in August, where I think the paper's called, it's got an awesome title. It's like A Better Way to Capitalize Intangible Assets. So it's literally something like that. And they go through the methodology, but at the very end, the primary author is a guy named Iqbal, I-Q-B-A-L, B-A-L. Iqbal, but it's Iqbal Shrivastava, Raj Gopal, and there's one other guy on it. At the very end, I think it's table 3, they actually go through most of the French industries. I don't think they do financial services, but most of the French industries, and they actually give you the ratios of non-R&D SG&A that should be deemed to be an investment. They go through, unlike Peters and Taylor, they do not assume that all of R&D is discretionary. There's a maintenance component there, so they go through that. And as important, they give you the asset lives. Okay, so what is the exercise we're going to do here is we're going to go through a typical company's SG&A. We're going to separate discretionary from maintenance. The discretionary investment will go onto the balance sheet, just like CapEx. And now we have an asset life, so we can amortize it, right? So depreciation's for physical assets, amortization for intangible assets. And so the net of all this is that earnings are going to go up, right? Because we're adding back an expense, but we're diminishing it a bit by the amortization. But earnings are going to go up net, and invested capital is going to go up net. And that's going to change the picture to some degree, and I think give us a more accurate view of the world. Now, going back to your joke about like 50 times earnings kind of thing, It's actually important because the first thing I always like to say to people, I usually do this as a quiz for my students, but I show them and I say, here's a company that has had negative free cash flow for 15 years in a row. Their debt levels have gone up a lot. Their cash balances have dwindled. Do you want to buy this stock? And the answer is that stock was Walmart. And Walmart had negative free cash flow for the first 15 years that it was public. The stock, by the way, crushed the stock market, right? It was an amazing investment. Why? Because the investments they were making had fabulous returns. So when you have high ROI investments, you want to invest as much as you possibly can. Now, no, just to make this really, really clear, you have one company that's buying machines. Let's say they spend $1,000 to buy a machine with a 5-year life. $1,000 goes on gross property, plant, equipment. Then we depreciate $200 to a straight line, $200 for 5 years on the income statement. Company 2 is acquiring a customer for $1,000 that will generate the same cash flows over 5 years. Both NPV positive, but every time we add a customer, we accelerate our losses because we're paying today for cash flows in the future. So the basic unit of economic analysis is, how does this company make money? For Walmart, it was building stores, but they were on the balance sheet. For the subscription business, right? So it may be the case that losing money is perfectly fine if it's for the right reasons. And the last thing I'll put it, just to put a cap on this, there's a very interesting paper by one of the big guys on this, the OG basically of this whole topic is a guy named Baruch Lev, who's at New York University. And Baruch did a paper where they looked at, and he wrote a great book called The End of Accounting, and his co-author, and he wrote this paper where they looked at 3 different types of businesses. Businesses that were profitable, businesses that lost money for the right reasons, right, because they're investing in intangibles, and then businesses that lost money the old-fashioned way, right? Their expenses are bigger than their revenues, and that's not good. And what they found is the highest total shareholder returns were from those good loss companies, right? So this goes back to the categorization issue. So people say, oh, a company's losing money, it's bad. That is lazy, right? That's like saying Walmart, it has negative free cash flow, so it's bad. No, you need to understand the underlying economics of what's going on. So again, I don't want to come across as an apologist for things. Like we're not apologizing for things. It's encouraging investors to learn about how to cope with this appropriately, analytically, to ask the right questions and get a clear view of where the value is coming from.
Great. And we all admire that. Don't worry.
The team at Counterpoint Global, they do a very deep fundamental analysis on each of the companies that you invest. You faced a very challenging year last year, yet the funds, the investors, they still remained very true to their core beliefs. So finding good, strong, sustainable, competitive companies with strong cash flow, free cash flow yields, and a very favorable return, their ROIC's trends. So this is, I think, key. What were some of the lessons that you learned from last year, events and results as well? And has any of the approach changed at all with your approach of investment in mind?
Yeah, thank you. It's a great question, and I guess that I might even step back and go back to 2020, and maybe the story would be something like things were too good, and then we needed to have a little bit of a correction, right? So 2020, as you know, for Counterpoint Global was a spectacularly good year, and I would just say, as an investment manager, people obviously will call you up when you have a bad year, asking you what happened. They don't call you up when you have a really great year, but they should call you up when you have a really great year and say, like, how come you were so good? Because no one's that good and no one's that bad, right? Just to be clear. So what happened in 2020 that was so favorable, like as a backdrop, that led us to where we were going into 2022? I would say maybe 3 things that I would point to. Number 1 is COVID, which was obviously completely unanticipated, led to an acceleration of the digitalization that had been a trend ongoing, right? And we all saw this. You guys spent some time at home, all that, and it pulled forward demand for those types of businesses. We happen to be probably disproportionately exposed to those kinds of businesses, that means their earnings prospects got better. So that's a little smiley face next to that, okay? Second component was, what happened to the discount rate or cost of capital? Well, the answer is central banks around the world centralized their behaviors to cut rates to create a more stimulative environment, which means that these higher cash flows now are being discounted at a lower discount rate. So higher cash flows, lower discount rate, that's a number two really positive wind in your sail, if you will. And then the third component, which I think is not fully appreciated, we wrote a little article about this for the Financial Times, but I think it's a really interesting observation, is that a lot of the kinds of business we own, I think, are embedded with what are called real options, right? The right but not the obligation to make investments. What drives option value? Volatility. So notwithstanding that central banks were lowering interest rates, the volatility was very uncertain. Like, how is this going to shake out with digitalization? What will the recovery pattern look like? Which businesses are going to come back and not come back? There are a lot of open questions. And one of the ways we can document that is to look at, for example, the ratio of the VIX to a cost of equity estimate. The VIX to cost of equity ratio in the 3 or 4 years prior to COVID was a kind of a 2-to-1 ratio. So call it a high teens VIX and sort of 8 or 9-ish cost of equity. And that ratio went bonkers, right? It went to like 4 or 5 to 1. So that actually helped values. It sounds perverse, but it helped values because these guys were long options, okay? So that's the setup that leads to a spectacular 2020, and then going to 2022. And I think the one way I would characterize 2022 is to say, let's look at expected returns and how those changed and how that had an impact on the stuff we were doing, but everybody else as well. One of the guys I really like on his, and who I rely on for this kind of work is Aswath Damodaran at New York University. And Aswath every month publishes his estimate of the market risk premium. So literally you take Aswath's market risk premium, you add it to the 10-year risk-free rate, and you come up with an expected return for the equity market. By the way, he's been publishing versions of this. He has annual data back to 1961. You plot the 61 data as the independent variable, and the dependent variable is 10-year total shareholder returns for the market. Correlation's about 0.7. Not perfect, but pretty good and better than nothing. So one of the things we know in academic finance is the best predictor of low returns in markets is low discount rates, and the best predictor of high returns is high discount rates, right? Sounds silly, but there it is. January 1st, 2022. So roll back your mind now, 18 plus months. Using Damodaran's numbers, the expected equity return for the stock market was 5.75%. That is nominal, by the way. Inflation expectations, which you can extract from the 10-year, were about 2.3%. So 5 3/4 minus 2.3. Okay, getting into the mid to high threes, pardon me. That's real. Okay, historical returns, the equity market, 6 to 7%. So we're a little better than half of expected returns from markets. That is not exciting. By the way, the signals you're getting from credit spreads, very consistent with that. So, and I think Dennis was talking about this at the time. He said, we love the portfolio. As you pointed out, like we do the work on these and we like the businesses in an enormous amount. We think they're very well positioned for the long haul. But he's like, clearly the environment's not the best environment. Fast forward 12 months. By the way, in the fall of 2022, we got to a double-digit cost of equity. But beginning of 2023, so beginning of this year, kind of low to mid 9s. Same inflation expectations. So let's just pick a number, 9.3 minus 2.3, you get to 7%. So we're in the band now, the high end of the band, actually, the historical range. So it would say to me that stocks are not like screamingly cheap, but we went from really out of bounds to now something a lot more normal. Now, to your point, you can isolate this one more way to say, like, what happened. And the core idea is that real rates in the States went from negative 100 basis points to positive 160 in the fastest delta in the last 30 years where we can measure this. When that happens, when real rates go up that fast, there's no place to hide. You're not hiding in credit. You're not hiding in any equities, and certainly if you have long duration equities, which many of our stuff is, you're gonna feel the pain. Okay, so that's all true. Now here's the last thing I want to leave you with, and this is, I think, an important observation, broadly speaking. We presented this internally, and maybe I should write it up for the world. The way I did it internally is the analyst that works with me, Dan Callahan, he's an awesome guy. He's got 2 kids, 2 beautiful daughters, one age 6, one age 4. And in the United States, as you guys know, going to college is a really expensive proposition these days. So you have to save early and a lot to make sure that you're sort of on track to be able to fund their college education when that moment comes due. So what I said to Dan was, pick your younger daughter. Her name's Clara. Pick Clara. So we're going to say Clara's going to go to college in 14 years. Let's say how much money are you going to need for her to go to college in 4 years? Just pick your number, right? $100, whatever it is. And then discount that at the original discount rate, 5.75%, like what the asset value today you'd need to get there, right? Assuming that rate of return. And then take that same $100 and discount it at the higher discount rate, right? 9.5% or whatever it is, and see what that number comes out to. It's a much lower price, right? And it turns out that delta was about 35% lower. Why do I go through all that labor to explain that to you? Because what it's saying is your terminal wealth may not have changed from 22 to 23. It feels really bad to have your asset price go down, but no one seems to pay attention to the fact that your expected returns went up a lot, right? And so if you need, now, by the way, if you're paying your tuition bill tomorrow, this is of no consolation to you, right? In other words, you lost the money and it's not coming back. But if you're thinking about Clara's college tuition in 14 years, like your world is not, you obviously don't like to have less money in your account, but your world is not that different, candidly, if those numbers are valid numbers. So it's a really interesting way to think about it. So that's what would give me confidence. And I think Dennis who runs our team, I think has been, quite mindful and communicating this, saying like, if you talk to him in late 21, early 22, he was like, hey, we like what we own, but the environment the backdrop doesn't look particularly attractive. And then rolling into 2023, he was like, now we're looking like we have very good return prospects. The unfortunate thing is investors tend to do the opposite. This goes back to your behavioral thing. Investors tend to do the opposite. So they're all excited in 2020 and 2021, and then they're all bummed out, and they sell at the wrong time and buy at the wrong time, or sell at the wrong time, buy at the wrong time. But that would be one. And I don't want to justify anything. And you're exactly right. One of the keys is, I think any great investment organization, you obviously want to learn and improve and get better at what you're doing, but the key is to stay calm and stay the course, right? And not to freak out. And so I think Dennis and the rest of the team, senior management, they set a very nice tone for this, that people sort of keep their noses down, really keep thinking through the businesses, have the types of vibrant debates and discussions we need to have, but keep our nose down. And then I'll stop talking, but the last thing you asked was like, sort of, what are the things that we do in our Consilient team to help? I think that, again, trying to shed a very bright light on things like intangibles and understanding these things, just to give people a way of making sure they're understanding or thinking about these things as richly as they can. We wrote a big piece called The Economics of Customer Businesses. We happen to own some businesses that are related to that. That really helps, again, frame discussions internally, frame our modeling, frame discussions with management teams, and so on and so forth. So I think there's a lot of stuff that where this research can be additive to what has already been a very good process.
Great. So I'll speed things up here, given the time that we have. So I'll summarize some of the last questions that we have.
Okay, so I have to talk faster.
No, don't worry.
Sure.
No, and I'll change gears a little. So as we all see here, you're a teacher, you're an author, and you're also head of research. Besides these 3 activities, you also are a dad. You have 5 kids. You've been doing great into all of those roles. So how do you find time to balance this and even be here with us back in Brazil?
Yeah, I mean, first of all, it's great to be with you. And I would just say that it all seems a little bit easier. It looks better than it is probably in real life. The first thing I'll say, and I really mean this in a genuine way, and I'm sure everybody can relate to this, but there's, and I think I said this on a podcast, but it's very true. If you have a life partner, that partner is a huge source of leverage, right? And I called her an amplifier, or asset, but an amplifier, right? So if things are good, it's just much better. If things are not good, it makes it much more difficult. And I have a great partner. My wife is amazing, so it is an amazing asset. And so a lot of the things like we're I would say truly partners in a lot of this stuff. So that has been a very, very, very crucial component to all this stuff. The second thing is, the reason I say that it looks easier than it is, it looks more impressive than it actually is in real life, is acknowledge that my job is I get to do research all day for the most part. It's it's not everybody's cup of tea, but it's very fun. So for me, I'm doing what I love to do every single day, and that makes things a lot easier, right? So I'm motivated every day because it's so much fun for what we do. And then the books ended up being spill-offs, right? So Rappaport came to me about writing expectations investing. My career was full on. My kids were young. I was working really hard. This is the late 1990s. And I just said to myself, and I talked to my wife and my boss about this at the time, I said, if I don't do this with this guy, I'm going to regret this on my deathbed. And why would I, it's not about money or whatever. It's like, why would I do that, right? And to have a second chance to write a book do the new version of him when he comes out when he's 90 years old, that's incredible, right? And so part of it was that calculation, just say, the deathbed kind of consideration. Now my kids are old, right? So the youngest is 21. They're all out of the house. It's all fine. So now it's like awesome. Now I get to work out. I get to sleep. I get to come to Brazil and hang out with you guys. Life's a lot easier. But yeah, I think those are some of the elements. And then teaching is another good example. I teach at night. So it's 6 to 9 p.m. It's typically, it's 12 weeks. So my wife had to, she had to buy into it, but she had to basically take a night once a week, 12 weeks for a year. And she was willing to do that. So, so it wasn't like I was completely missing in action, but it was, she had to sacrifice for that.
I want to talk a little bit about culture at Counterpoint. I know that you guys are very insightful, and you really try to have a critical mindset. And you pointed out that you make those decisions based on the deep research that you also provide to the analysts and the team. And this is something that's very culturally strong and very particular for Counterpoint. You even have a book club at the team. What were some of the most interesting or exciting insights you got from the team?
Yeah. Well, I think a big part of it is, look, I think that, and I give all credit to Dennis Lynch in this regard. Dennis has a nose for finding really interesting people, and I think even more important, for letting them do what they are good at. And, once I was actually talking to a sports executive, and he was saying, I said, what is a great manager of a sports team? What do they do? And he said, they put all of their players in a position to be as effective as they can be. And I've always loved that, right? A great manager puts all the people that they work with, they make them the best they can be. And whatever that position is or whatever that activity is. And I think that's what Dennis does above anything else. The other thing, just to state the obvious, that Dennis has, what we do for many investment organizations would deem to be a luxury, right? You have some guy that sits around and thinks all day and writes, and he allows him to teach at Columbia Business School. And, I am doing a lot of stuff internally, but, to some degree, I'm not directly managing portfolios. I'm not directly building models and all that kind of stuff anymore. So that's a major commitment, I think, and indicative of what sort of the culture he's trying to build. And then the other thing I would just say that it is, what have I learned is the answer is we have a lot of really interesting people that have a lot of different interests and skills. And so when we get together, have our investment meetings, for instance, there are just a lot of interesting ideas that people have and that they're surfacing, and stuff I would never think of, or stuff I wouldn't even it wouldn't cross my mind, that I think is really helpful and
any highlights that you heard from?
No, I just think that a lot of the stuff that probably when you say highlights, the stuff that seems to me most interesting is often the stuff that comes out of our disruptive change team, right? Because these guys are allowed to go off in a little bit and
they're
check
thinking
out
30 years ahead of
they're
everyone.
thinking 30 years ahead. So there's some stuff like what's happening with elemental energy or nuclear energy. I've been fascinated by essentially in our society, the reintroduction of psychedelics and what that could mean broadly for mental health and those kinds of issues. That's cool. I'm also interested in all this health stuff. So we've done really interesting work on wearables. That stuff is super cool. And to state the obvious, sort of front and center, is true for every organization, sure as well, is all the stuff on AI. So, how do we think about AI? How does it affect our portfolios? so on and so forth. So yeah, it's just a lovely group of people to hang out with. They're just the people are smart, they're friendly. You enjoy not only working with them, they're curious. Yeah, even the book club is a good example. And often, a lot of our book club ideas I come up with, but a lot of them are people coming to me and saying, "Here's a really important idea," and then they sort of take the lead on and actually the whole process, which is great.
Great, thank you. So we'll allow just anyone has a question here in the audience, or if there's anyone sending the question to the number that's here on the screen, on the chat.
Tem uma pergunta aqui. Vou perguntar. I got a question. This is why I have my cell phone here. Do you have any hobbies in your spare time? If you have any spare time, and what are some of your favorite books? I saw a few interviews you gave on YouTube, a few videos of interviews of yours. You have a very big library of books. You did mention a few books that you love, but love to hear some of the other favorite books you have.
Yeah. So for hobbies, I mean, a lot of it is actually reading. It sounds like very nerdy to say that, but I do enjoy reading. I also am very involved. Like I play sports still. I mostly play ice hockey, and I'm still very interested in fitness. By the way, the one book that's been mostly consuming me in 2023 is Peter Attia's new book called Outlive. You guys know this book? Yeah. You're on it? You're on it? You're on it? Okay.
We're on it.
So, and I'm trying to live this to some degree, by the way. So I've had to make some changes to what I'm doing. So those are the big things. And I love to travel, by the way. Our family just came back. We have 5 kids and now a daughter-in-law and a mother-in-law. So this is 9 of us all together. And we just came back. We spent a couple of weeks in Greece, in the islands, and it was just awesome. So that was fun. So just now for me, hanging out and traveling is super fun for the kids. In terms of books, it's really hard. And one thing I'd be willing to do, I'd be very happy to do actually, is I have a reading list, which I'd be happy to share with you guys. So it's not like super secret or anything like that. And that I organize the reading list by different topics. So part of the answer to that question is, what are you interested in, or sort of like what's an itch you want to scratch today, and sort of go down that path. But there are a couple of books that I usually do recommend to people. One of them, and these are, okay, so the other one, this is interesting. So this might be another way to answer this question, although you guys might be too old for this. But my oldest son did a gap year before he went to university. So he's 18 years old. He's like a thoughtful guy. And so I said, I'm going to give you 15 books I think you should read in your gap year, besides doing all the other stuff that you're doing. And so I created a list for him, and he actually went through them and read them all. So someone asked me about this, and I was like, I don't know if I asked Andrew, do you have the list? He's like, I don't have it. Anyway, so we try to recreate the list, but that included books like Steven Pinker's book, How the Mind Works. I'm a fan of Steven Pinker's stuff, broadly speaking. He's a cognitive psychologist at Harvard, but he's written a lot about rationality and so forth. It included a book called, Consilience was on that book by E.O. Wilson. I had some finance stuff. Peter Bernstein, Against the Gods, The Remarkable Story of Risk. A beautiful, fabulous story about that. I'm trying to remember what other books, but anyway, I'll send that list on to you guys, and you can sort of check it out.
Okay, that was great. Well, thank you very much for being here with us. It was a pleasure. Thank you, guys from Morgan Stanley. Vitor, Ju?
Alguém quer se habilitar a fazer mais uma pergunta? Senão a gente já vai encerrando por aqui. Não.
So that was it. Thank you.
Thank you, Michael.
Thank you very much. Appreciate it. Enjoy the weekend, everybody. Thanks.